Hi, this is Tom Galvin, co-CIO of Sandro Wealth Management. Welcome to this video update on private market perspectives. Media scrutiny and investor anxiety continues to run at elevated levels around the health of the private credit industry. We believe it is driven by a confluence of three key concerns. Firstly, credit risk. Secondly, increasing redemptions. And thirdly, the realization from some that not all private credit strategies are created equal. Now let's dive deeper into these three sources of concern. First one, investor concern on credit risk. There are two drivers as we see it, economic and technological. Regarding economic concerns, our view has been shaped by various data series that show the economy has been and will continue to go through a normalization process of credit quality, with delinquencies and defaults rising among consumers and corporations. This trend, particularly among lower quality borrowers, while clearly impacting business development companies these last several months, is not unique to the private credit industry. As indicated in many recent earnings reports, this delinquency trend is also being seen across major lenders, large U.S. banks, and credit card companies. On the technological credit concern, we believe risks posed by AI on existing software and SaaS companies will vary by segment and on a company-by-company basis. There will be winners, there will be losers, but it will take time to unfold. So the aggregate risks are likely not as great as currently feared. Net on credit concerns, we do not view recent developments as a signal of systemic weakness that is unique to private credit strategies. Inputs from numerous data and industry sources indicate that defaults and non-accrual loans remain within historical ranges. Second investor concern, redemptions. Rising redemptions are making headlines from companies such as Blue Owl, Blackstone, Clifford, among others that are largely concentrated in business development companies and semi-liquid strategies. As the investor base of private credit firms has expanded from institutions to individuals, some of these newer investors may not have realized what a quarterly redemption limit actually means. It is materially different from owning a publicly traded stock, where if an investor gets nervous and wants out, 100% sale can occur in seconds. A 5% redemption rate for private credit equates to about a 20% per year withdrawal limit, implying a 5-year holding period. So net as we see it on the redemption concerns, liquidity monitoring is embedded in our ongoing manager oversight. To date, redemption activity across our approved strategies has remained modest in the 1% to 4% range. Redemption requests are being fully honored, and there's been no changes to stated liquidity frameworks. Additionally, and importantly, understanding and explaining liquidity issues is incorporated in our discussion with clients. Third concern, the realization that not all strategies are created equally. So within this cohort of strategies that are making the headlines, the level of returns varies significantly over the last 12 months. Based on performance data from FactSet and other service providers, several strategies that invest in higher risk areas such as business development companies and commercial real estate have seen their prices, their NAVs decline 50 to 60% over the last year. Other strategies, however, that focus on lower risk lending and are senior in the capital structure are performing just fine. Also, based on our observations of publicly available performance data, strategies that are backed by long cycle assets such as infrastructure that also have tailwinds of technology spending and global industrial policy have done well in the last year. To date, performance and credit quality are on track across the managers that are approved on the Sandro platform. Net as we see it, we've purposely avoided these higher risk private credit segments and are focused on lower risk, higher quality areas. This has been guided by our analysis of economic cycles and a rigorous fundamental due diligence process. In conclusion, private credit market concerns may not dissipate in the near term, so keep your seatbelts fastened. After several years of strong performance, dispersion of returns among managers is likely to increase, and selectivity becomes even more important.
Yeah.
We believe the Sandro Wealth approach to private markets over the long term can result in enhanced returns and diversification benefits within our total portfolio approach. So please reach out to us for a more detailed discussion. This is Tom Galvin. Thanks for watching.